We are off to new highs again. 30 minutes until the start of trading. I'm Matt Miller. Dani Berger is making her way downtown for exclusive interviews with Brookfield's Bruce Flatt and Connor Teskey. She joins us with those later this hour. Bloomberg Open Interest starts right now. As you can see, stocks are set to notch fresh records as PPI surprises to the downside, supporting the case for a rate cut. And it's a great day to be Larry Ellison. A bullish outlook from Oracle, surging in the stock. The AR trade has been supercharged. And all that AI optimism has Wall Street strategists racing to lift their targets on the S&P 500. We have target lifts from Barclays, Deutsche Bank, and Wells Fargo in terms of the majors. Here, take a look at Oracle stock right now, up 32% in the pre-market. That would add more than $200 billion in market cap after Oracle gave an aggressive outlook for its cloud business, with the firm emerging as a key provider of computing capacity in the AI world, challenging those I guess more traditional incumbent hyperscalers that we all know and love. And Novo Nordisk is cutting 9,000 jobs globally. It cut its profit forecast for the third time this year as it fights to recover ground lost in the obesity drug market. And you see those shares just barely treading water right now. But we begin with PPI, unexpectedly falling, boosting Fed rate cut bets and sending stocks higher. Michael McKee's is Bloomberg's international economics and policy correspondent. He joins me now here at the desk. So, Mike, the number looks incredibly dovish for the Fed.
Well, it does suggest that the Fed can go ahead with a 25 basis point cut. But let's not talk about 50 yet, because there's some numbers in this that put a lie to the idea that this is extremely dovish. A headline does come in down 0.1%, and July numbers for headline and core on a month-over-month basis were revised lower. The core comes in at 0.1% drop as well, and 2.6% for headline CPI, 2.8% for core. But look down at the bottom there, 2.8% for core X trade on a year-over-year basis. That's the highest since March. And core trade is basically margins for the retailers and wholesalers out there. And what we're seeing is retailers and wholesalers, apparently margins compressed, and they were down, and that is why the overall PPI was lower. Some of the categories that fell, vegetables were up 38% in July, down 15% this month. Cigarettes were a big mover, up 2.4%. We don't really have a reason for that.
Cigarettes?
Apparently they do.
Gross.
And here's the number I was kind of talking about. Wholesaling down 5.2%. Air travel up 1%. That goes into the PCE, so we'll be watching that. But there is some tariff inflation out there. You look at coffee up 6.9%, electric components 5.1%, iron and steel scrap up 2.7%. So we are seeing some feed through, maybe not as fast in as many areas as we thought. But again, it may be because wholesalers and retailers are absorbing some of these costs in their margins, and at some point they're going to have to raise their overall prices. Tomorrow, CPI, that'll be definitive.
Right. Well, I mean, I wonder if we'll see that in the CPI number tomorrow as well, the difficulty pushing through these cost increases to consumers.
Well, we'll be looking at things like apparel, where you have a big retail and wholesale intermediary in between with inventories, and we'll see what kind of prices have been passed through and what have not.
All right, Mike McKee is going to be covering this all day as the market rallies to all new highs. Not hurting that rally, Oracle shares. They are at all-time highs after the company gave an aggressive outlook for its cloud business. Here's what Wedbush analyst Dan Ives had to say on Bloomberg Surveillance earlier.
Many that are skeptical of maybe like some of the growth. You look at these numbers, that ARR number, that's a drop to Mike. And I think what that shows, the rest of tech, the rest of AI, that's what we continue to say. It's 10:15 in the AI part, it was 9 p.m., and that part, it goes to 4 a.m.
That actually works, that jacket sweatshirt combination. There's so much going on with Dan Ives, it's hard to focus really on his tech calls. But look, he's bullish. Pretty much everything that he covers, and Oracle is one of those. And to me, the interesting thing is Oracle looks now like a challenger to these big hyperscalers in the Mag 7.
That's the big story. You know, the change in the environment for cloud computing and the hyperscalers. If you want, I'll try and decipher what Dani was talking about. Basically, Oracle has a backlog of about $455 billion of orders, commits. And it also gave us some growth numbers for the infrastructure business, right? Saying that it would grow to $18 billion this year, representing 77% annualized growth. But this 2030 target, where it would hit almost $145 billion. And I think what they're doing is saying, here is what your backlog looks like, which is astonishing, like $455 billion of business. And here's how we think it will play out in terms of actual revenues booked over the next 5 years. But team in the control room, can we just show the pre-market gain again? Because it's astonishing.
Yeah.
This puts it on track for its biggest jump since 1992, which the year I was born. But that's a serious vote of confidence by the market.
Yeah, it's in the side panel. You can see up 32% right now. I should point out to viewers who aren't glued to a Bloomberg screen all day, you are Ed Ludlow, co-host of Bloomberg Tech. And
thank you.
Let me also ask about your assignment yesterday. You were at Cupertino. Apple came out with some pretty interesting stuff, frankly. We talked about it a lot in terms of the pricing as well as in terms of the consumer product offering, heartbeat sensors in the AirPods. But the stock has not reacted positively at all. What gives with Apple?
Yeah, you know, in the pre-market, we're down 0.6%. So in aggregate over 2 days, down, let's say, more than 2%. We got the iPhone 17 generation. Basically, to every single detail, it was as Bloomberg reported it would be, and full credit to Bloomberg's Mark Gurman for that. The hardware innovation was in the 17 Air, the thinnest ever smartphone, 5.6 millimeters of thickness. Samsung has an ultra-thin smartphone that is 5.8 millimeters of thickness. So that it's becoming a segment, there's a market for it. But you're absolutely right that the focus is that they did not raise prices in a substantive way. We know that there would be pressure to because of tariffs, the higher cost environment that they're in. Now you see some of the carriers, T-Mobile, we spoke to, but Verizon, AT&T, basically say, we'll give you this handset for free. The stock story is very simple. It is almost always in history a sell the news moment. But look at the stock, what happens after that. And often when a handset is successful, the stock will do much better in a short-term 30, 60-day period. Or as you pointed out to me yesterday, look at the stock on a annualized or 5-year basis after the big moments in hardware, and Apple tends to rebound. Very quick, you know, we're waiting on the AI software piece. But many of the leading experts in this field would look at what they did with their own in-house semiconductors and say that these are phones on the hardware side very capable of performing whatever software innovation Apple brings to us eventually.
All right, Ed, thanks very much for the rundown on Oracle, on Apple. We'll be tuned into your show, Bloomberg Tech, at 11 a.m. this morning. Let's turn now to pharma news. Novo Nordisk is going to slim down, cutting 9,000 jobs globally. It has also cut its profit forecast for the third time this year as it tries to compete with rival Eli Lilly in the booming obesity drug market that it pioneered. Bloomberg health reporter Damian Garde joins us now with more. And it's astonishing to me that, you know, Novo at one point seemed like it was going to rule the world with GLP-1s or semaglutides. And now it looks like tirzepatide and Zepbound from Eli Lilly are really stealing its march.
That's absolutely true. And what's jarring about this to me, honestly, is the job cuts were arguably expected. Novo has been signaling that there will be a reset. But this being the third, as you mentioned, clawback of their profit guidance suggests how many resets are we in for exactly? When can we say definitively that the other shoe has dropped as Novo seeks to resize itself and kind of change expectations as it's losing ground to Eli Lilly? It is important to remember they do still lead the market. It's really just the trajectory that I think is driving both the actions that they've taken and the fact that their stock is down about 60% in the past year, which is that Lilly's product is on pace to usurp Novo's. And then looking outward, Lilly's pipeline of follow-on weight loss medicines is just looking more promising. Novo has had some clinical disappointments, and Lilly seems to be a step ahead strategically in terms of making the most of this market.
All right, Damian, we'll continue to follow your reporting. I'm waiting to see when they come out with a successful oral medication for this, as are, I think, millions of other people. Damien Garde there covers healthcare for us. Now let's get to IPOs. Klarna is set to begin trading today. Bloomberg sources say the fintech is telling investors it expects its price to price its initial public offering of as much as $1.2.7 billion above its marketing range. I'm not sure what that means. What does that mean? Let's bring in Bloomberg's Bailey Lipschultz here, who covers IPOs. They're expecting to price, I'm guessing, at the top of the range.
Priced. They priced above the range. So the top end of their marketed range was $37. They priced it last night at $40. So ultimately raising for the company and shareholders $1.37 billion. Right now, ahead of the green shoe, top 5 deal so far in the U.S. So all eyes will be on how this deal is received by investors, how we see the market really react when we get those indications and really get trading in a few hours. Obviously, all eyes have been on a number of companies like Klarna that have been held private for quite some time, so over a decade since this company was founded. And now we're finally seeing the IPO after being stalled out back in April.
$1.37 billion.
Correct.
So even more.
Even more.
What are the chances that they left a ton of money on the table? That they left literally 100% on the table?
I was talking to a senior banker at one of the big Wall Street banks yesterday, and I was asking him about that. How do you feel when you see stocks open up 80% or 150%? And the point he made is that part of that is retail, part of that is momentum. But when you look at some of these companies, they've really given back chunks of those gains. So looking just at the terminal, Figma, we all talked about how it opened up, 250% on day one. It's only up 62% now. So these are big swings that are happening in 1, 3, 5 day stretches, but then giving back a bulk of those gains. So while we will write about the opening trade of Klarna, the big question will be, where's the stock a few weeks from now? And more importantly, where is it 6 months from now when those lockups come off and more insiders can sell?
So what you want is for those who got in initially to flip the stock for a profit to the suckers. And then
some people would say that. Yeah. I mean, everyone's making money on these deals. That's the big thing. As long
not if you buy it on the first day.
As long as you don't buy it at the top.
Right? Yeah.
As long as you don't buy it at the top, you're making money.
Bloomberg senior stocks reporter Bailey Lipschultz covers the IPOs and the memes and the SPACs for us as well. Don't miss our interview with Klarna's CEO. That's an Ed Ludlow show at 11 a.m. Eastern time. He co-anchors that, of course, with Caroline Hyde, Bloomberg Tech. Definitely want to check that out. Coming up, Fifth Third falls as the bank discovers alleged fraud. It discovered alleged fraud at one of its commercial borrowers. More on the challenges facing that regional lender. And later this hour, my co-host Dani Berger joins us from Brookfield's headquarters in New York ahead of her exclusive interviews with the company's CEO and president. This is Open Interest. Let's get now to high interest. Look what's making headlines around the world. Poland shot down drones that crossed into its territory during Russia's latest airstrike on neighboring Ukraine, calling those drones an act of aggression. Poland's Prime Minister Donald Tusk said he had activated Article 4 of NATO's treaty, under which members can demand consultations with their allies. This is the first time NATO assets have directly engaged with Russian targets since Russia's invasion of Ukraine in 2022. Robinhood is breaking into social media with Robinhood Social. The platform will allow retail traders to share their positions and post about their investment victories and losses. The company, I should say, will invite a small group of customers to join Robinhood Social early next year, then broaden the availability later. That's a beta testing model. Initially, all posts will be required to include a trade of equities or other assets. The CEO, by the way, Vlad Tenev, joins Bloomberg Television on the close at 3:30 p.m. New York time. And Fifth Third Bancorp says it is the victim of fraud on a loan with a $200 million balance. The bank believes the situation was an isolated incident in the company's warehouse lending business. According to the CEO, Tim Spence, the regional bank is also among the financial institutions bracing for what could be hundreds of millions of dollars in combined losses from loans tied to the subprime auto lender Tricolor Holdings. And joining me now at the desk to talk about that is Herman Chan. He's the regional banks analyst for Bloomberg Intelligence. And Herman, what is the story with this loan book? It's subprime auto loans, right? And Is it possible, for example, that they made a lot of loans to undocumented immigrants who have since left the country?
I mean, that's possible. The party line from the bank management team is that there was an issue with the underlying collateral. And these loans are really bridge financing, short-term type loans to the borrower. And unfortunately, there was a fraud issue with some issues with the financial statements and the collateral, and that's where we are today.
So what are they going to do about it? I mean, do they need better oversight at their warehouse lending unit? Are there wider implications of the Trump immigration and deportation policies? They're going to hit regional lenders hard?
Well, what they've said, what Fifth Third has said, is they're going to look internally at their policies, making sure their processes are on point, making sure they have a really good idea of what the collaterals that are backing these loans, and maybe even potentially pulling back on the lending related to these warehouse facilities. So there's going to be a lot of inward focus in terms of could they have prevented this and what they can do going forward.
So Tricolor, I guess, will want to refocus its business as well, but I'm also guessing it's going to be subject to a decent lawsuit.
There's going to be a lot of litigation, and given the fact that there's a lot of parties involved, Bloomberg News has reported Barclays and JP Morgan are also ensnared in this issue, so we're going to see a lot of litigation. It's going to play out over a number of years.
What are the bigger banks involved? I mean, how is JP Morgan, for example, dealing with this?
Yeah, so this is the same issue with Fifth Third. They have exposure to the warehouse facility.
But it doesn't hurt as much. We won't see it play through in the shares as hard.
Probably not. And for Fifth Third itself, the loan was pretty sizable for the regional bank of that size. So for a bank like Barclays and JP Morgan, probably more of a blip, but still will affect possibly some of their provision expenses in the third quarter.
All right, Herman, great having you back on set here. Herman Chan of Bloomberg Intelligence, made famous during the SVB loan crisis. A check right now on futures ahead of the opening bell. We are going to see green arrows here across the board after the PPI number came in cooler than expected. That gives the Fed cover for at least a 25 basis point rate cut, and that's why you're seeing 0.5% gains on the NASDAQ and the S&P. This after all-time closing highs yesterday. I think we closed at 65.12 on the S&P 500. Coming up, Deutsche Bank and Wells Fargo. Speaking of banks, but bigger ones, see the S&P 500 closing the year above 7,000. We'll discuss those targets with JoAnne Feeney of Advisors Capital. This is Bloomberg Open Interest. Wall Street forecasters are rushing to boost their outlook for the S&P 500. Barclays raised its year-end price target to 64.50, citing interest rate cuts, strong corporate earnings, and AI-centric growth. Of course, we're already far past that. Deutsche Bank raised its target to 7,000, and Wells Fargo raised its year-end target to 7,200, with equity strategist Oh-Sung Kwong writing, quote, "There is froth, but as long as AI capex remains intact, the bull market should continue." Let's bring in JoAnne Feeney, Advisors Capital portfolio manager and partner. And JoAnne, there is froth, but after something like Oracle yesterday, it seems like maybe we've even underestimated the incredible amount of spend that's already priced in on AI.
Yeah, good morning, Matt. There certainly is a recognition that Oracle's news creates a better view of what's actually happening in the demand for the use of AI. The fact that the other hyperscalers look like they are offloading some of the demand for their capacity over to Oracle, and not just temporarily, but for the longer term, tells us, perhaps resolves an outstanding question, which is AI really being used? Is there sufficient demand to keep the infrastructure spend going? So when you think about the economic growth engine, it's clearly AI, and it's clearly something that starts in the Mag 7 and is likely now to be spreading to the other 493.
So does that mean you want to be selling out of those mega tech cap stocks and using mega cap tech stocks and using that money to buy companies that have underperformed thus far?
Well, there's certainly an important reason to look around the market. As you were just saying in your opening remarks, the market is expensive, and we don't play the game of what is the S&P 500 going to do. because we don't invest in the S&P 500 as a whole for clients. We want to be selective. That said, we do still think there's an awful lot of infrastructure spend to come in AI. So you want to continue to be exposed to those key players, whether it's an NVIDIA, a Broadcom, Microsoft, Amazon, or others. We still think those should be core holdings, but don't disregard the value opportunities elsewhere.
So where do you see the biggest value opportunities?
Look across sectors. I mean, industrials is one place to look where AI is being adopted, some in very obvious ways. Companies really point that out. Other companies will use it for their back office to make things more efficient. Also to develop new products, whether that's an Emerson, an Eaton, a Honeywell, or a Caterpillar. They're all using AI. And that's not the only reason to own them, obviously. I mean, these are solid companies with strong end market demand. We're seeing a recovery in the industrial space. We think that's likely to continue.
All right, JoAnne, you're going to stick with us here for the opening bell. JoAnne Feeney is going to tell us what her barbell strategy is. Let's get a check on futures ahead of that open. Right now, we're looking at 0.5% gains after an all-time high yesterday at the close. 65.12 was the level, which is why a 64.50 target doesn't really look that aggressive. The Nasdaq right now at over 24,000, over a 0.5% gain there as well. And interestingly, the small caps not doing quite as well, up only 0.2% at 23.89 in the Russell 2000. Of course, they have been outperforming of late, and they do need a rate cut, maybe more than the bigger cap indexes. We will be back in just 30 seconds with the opening bell on the Nasdaq and the New York Stock Exchange. This is Bloomberg Open Interest. Moments away from the start of trading, moments away from the start of a brand new record high, at least if we were to close at these levels. I'm Matt Miller. This is Bloomberg Open Interest. S&P 500 futures up 0.5%. Futures on the Nasdaq up 0.5%, and that should translate into a gain above the 65.12 closing level of the S&P yesterday, which we just ratchet up higher and higher and higher every couple of sessions here. One of the reasons for that, you see and hear the opening bell on the New York Stock Exchange. Klarna coming out with one of the most anticipated IPOs of the year. Bailey Lipschultz was talking to us about that, a $1.37 billion raise, and we're going to talk a little bit later about that some more. Take a look down at the Nasdaq. You've got Answer the Call ringing the opening bell. This is New York Police and Fire Widows Benefits Fund there. So not a publicly traded stock, but a noble cause. In terms of the drivers today, Oracle's big gain, and this is the live trade now, 30%, adding more than $200 billion to the market cap. It gave an aggressive outlook for its cloud business when it came out with earnings at the close yesterday. It's a firm that's emerging now as a key provider of compute power and capacity in the AI world, really taking on those hyperscalers. On the downside, Novo Nordisk slashing 9,000 jobs globally. It cut its profit forecast for the third time this year as it fights to recover ground lost in the obesity drug market. Damian Garde saying they still have the biggest slice of the pie, but it's not growing as much as Eli Lilly. Let's bring back Advisors Capital Portfolio Manager and Partner JoAnne Feeney. And JoAnne, we were talking about this growth value barbell strategy that you're employing. Where do you see the growth side that you don't already own?
Well, Matt, it's going to depend on the strategy, whether it's our growth strategy, our SMID strategy, or some of our balance strategies, the kind of mix we want to hold. The growth right now that is most obvious is in that infrastructure build, most recently displayed by Oracle. Beyond that, you have to look at, I think, a number of factors that can drive growth. It's demographics in addition to AI, right? It's the continued demand for healthcare, whether it's medical devices, whether it's, services, for example. So there's a lot of places one can find growth, but it's essential to recognize that one needs other things in their portfolios, outside of the growth strategy itself. In a balanced strategy, you might want income. And so maybe you don't, emphasize growth as much there. You're looking for value. You're looking for strong dividend yields, well supported by free cash flow.
What about diversification? How key is that, JoAnne? And, I guess it's tough if you're not investing at the index level, or do you pick stocks from different regions, different industries? How do you diversify?
Yeah, so we don't invest in the index for clients, but we definitely diversify. And you can get quite a lot of diversification into client portfolios by, owning for them, 40 or so stocks. And so we do look across sectors, and then within sectors, there's a lot of different industries within each sector. In healthcare, for example, medical devices, pharmaceuticals, laboratory equipment, these all offer a way to diversify. And again, then you get that mix of, how can you find value among these companies? And there's really plenty of value to be had out there.
Are there places that you want to stay away from? And we've talked about the concentration risk and the Mag 7, and I'm sure that your clients already own those stocks. But is there something else that you'd like to avoid?
Well, we don't own all of the Mag 7. We are pretty judicious in which stocks we want to hold. Again, different portfolios own different different particular stocks. Things to avoid, I think, are things where you can't assess risk very well. And right now, we certainly face a lot of risk. The tariff situation, while it's understood mathematically that a tariff increase will cause a one-time increase in prices, as Powell said at Jackson Hole, it's a one-time increase, but it doesn't happen all at once. And so the tariff pass-through is going to be slow. We're seeing retail margins come down in the latest PPI report. So there are certain types of retailers we may not want to hold because these tariff increases, those price increases, are going to impinge upon budgets more severely over time. So the low-income consumer, we still see as particularly under threat. And that's an area, their demand is an area to avoid.
So the low-income consumer under threat. I wonder what you think about this GLP-1, not this specific story today about the firings at Novo Nordisk, but the effects of it. For a while, we thought it was sort of the runner-up story to AI in terms of market impact. Has it worked out that way? What do you think about that in healthcare?
Well, I think the opportunities in that particular trade are pretty narrow, right? You only have a few companies to play with, and then there's the monitoring of the potential development of an oral drug that does the same thing. We know, unfortunately, that the oral delivery is far less efficacious in terms of the amount of drug you take to have the same effect. And so the thing to watch there is whether those oral drugs develop in a way that they become more efficacious without having more side effects. So right now it's a very narrow opportunity and one that has a lot of risks. As you can see, whenever you're in a two-horse race, it's just very it makes you very vulnerable as an investor unless you want to own both of the companies at this point.
Well, what do you think about first of all, do you, JoAnne? And then what do you think about the rest of healthcare?
Yeah, we don't own those names. The rest of healthcare, we see a lot of opportunities, companies that are far more diversified than those two. Look at Bristol Myers, for example, trading at a very attractive multiple below 7 times forward earnings, or Pfizer. These are companies that have some headwinds because of legacy drugs coming off a full patent protection, but they also have very deep pipelines, and they have the balance sheet to support the growth and development of those new drugs. And we're starting to see some good results. These are two very attractively priced stocks, by the way, with very nice dividend yields, which really help our clients that are looking for income.
All right, JoAnne, great to get some time with you this morning. JoAnne Feeney there of Advisors Capital Management talking to us about her strategy as we hit all-time highs on the market. Let's get a check right now on the S&P 500, trading at 65.48, so that's an intraday high, and obviously it would be a closing high as well. This is the move screen. You can see that after a strong open, we quickly dropped and are climbing again. The breadth is evenly split. We've got 249 stocks gaining, 248 stocks down right now. But you've got the half of the Mag 7 on the upside, half on the downside. NVIDIA right now up 3.5% after those Oracle earnings. So it can't be overstated how key that is to the gains on the S&P. Oracle itself up 35% this morning. On the downside, you have Apple. We saw it down 0.6% in the pre-market. It's now down almost 2% in the cash trade. So it looks like investors are disappointed with what they got yesterday from the iPhone 17, AirPods, and Apple Watch. Amazon also down 1.7% this morning. In terms of the industry groups that are moving this morning, take a look at the split here. It's also pretty even with IT, with tech stocks the top gainer. Energy, utilities also gaining, which is typically fairly defensive, although energy moving around because of geopolitical moves today. Consumer discretionary, the big loser, and that's what you would buy if you were really bullish this market. So it's interesting to see it on the downside. Comm services and healthcare, as well as consumer staples, off as well. Coming up, analysts across Wall Street are raising their targets for Oracle following that blowout earnings report, and we'll bring you the details with Mandeep Singh of Bloomberg Intelligence. This is Open Interest. Time now for our top calls. Some of the analyst action that's in focus for us this morning. First up, Evercore downgrading HP, Hewlett-Packard to in line, saying shares are now fairly valued in the wake of recent strength, and they are off on an up day. Next up, TD Cowen upgrading Nike to buy from a hold, pointing to strengthening margins and notable market share gains. Maybe it's about time if you're a shareholder. They're up 0.7% today. And finally, Bank of America upgrading Oracle to a buy after earnings blew out expectations, highlighting the company's impressive forecast and robust demand for AI-related products. Let's talk about that right now with Mandeep Singh from Bloomberg Intelligence. He runs tech coverage for that unit. He joins me here at the desk. And I thought it was interesting. In the write-up today, BN said Oracle's results stunned Wall Street. I mean, that's pretty strong language. And you can see by the gain, 35%. What an incredible result.
Yeah, and look, the backlog, the number that they gave clearly suggests that when it comes to AI, there is some share shift going on in terms of training versus inferencing workloads. And Oracle is catering to both training and inferencing workloads, whereas the hyperscalers, especially Microsoft and Alphabet, they are focused more on inferencing workloads. So from that perspective, OpenAI will likely go to Oracle for training the next model, even though GPT-5 wasn't that big of a deal, but they will constantly improve their models, and they're going to Oracle for that capacity. And the longer-term deals that they talked about will result in, almost a 14-fold increase in Oracle's infrastructure revenue over the next 4 years, which is huge. So to my mind, the GPU capacity right now is being allocated in a way where Oracle is a big beneficiary, to the extent that we almost always talked about three main hyperscalers. Oracle is definitely the fourth big hyperscaler. Probably it will take over one of these three. Who knows? But that's what the forecast suggests.
So Microsoft, Google, and Amazon were previously the three main hyperscalers.
Yeah.
But in order to grow at this breakneck pace, they need a bigger share of Jensen Huang's NVIDIA chips. And if Jensen says, oh, no, Larry's going to get more of these right now at Oracle, then those three have to suffer, right? It's a zero-sum game right now.
Well, definitely from an NVIDIA allocation perspective, I would agree with that comment. And also, NVIDIA is allocating a lot more of their GPUs to other neo-cloud providers, which is why we hear about Nubis and CoreWeave and, Lambda, Crusoe. So in the cloud world, we just had three hyperscalers dominate everything. In the AI workload world, you will have a more fragmented tail, and that's what it seems like. I mean, Oracle could actually surpass one of these three, as I said, and it's very much possible with the guide that they gave.
I'm looking at the ANR chart on the Bloomberg terminal, and the yellow line is price. The white line, if we show it again, is the 12-month price target for analysts. And when the white line can't keep up with the yellow line, that's when things get really interesting. That's when it goes parabolic. Is that happening for this now less than a trillion-dollar company?
I mean, it feels like that NVIDIA moment, when NVIDIA blew out their numbers for the first time because of the GPU demand. It feels like that for Oracle, and clearly this is recurring revenue. Yes, there is a leasing component and backlog. It's a commitment, so companies can get out of that. But look, I mean, we're talking about a company that dominates the on-prem database world, and that is what they called out, that they will help a lot of those customers move from on-prem to cloud AI workloads through their infrastructure, which is why they have so much runway, because they do dominate that on-prem world.
We were talking about yesterday Oracle shares like up 40%. Right now they've doubled year to date. They're up 533% if you reinvested your dividends over the past 5 years. They're just crushing it. And I want to shout out also Brody Ford, the Bloomberg News reporter who wrote such a fantastic piece. He says that this forecast galvanizes hopes the post-ChatGPT global AI infrastructure build-out is accelerating. Yeah. It's hard to imagine accelerating from the pace where we're already sitting. All right, let's move on to Apple, because this is a stock that's down today, or at least it was down right at the open, and worse than the pre-market, actually. Yesterday, they had these iPhone 17 releases, including the thinner one for just under $1,000 or at $1,000, and earbuds that can track your heartbeat. Sounded really cool, but analysts and investors really not impressed this morning.
I mean, with Apple, they have great specs with this new version. You have to ask yourself.
They have great specs with every version, dude. I saw, the thinner one that they said has a weaker camera is still 48 megapixels.
Amazing. But then when it comes to AI use cases, I thought they showed a pretty cool demo around AirPods transcription. To me, that feels like an incentive to upgrade my AirPods. Now, for the phone, even though they have great specs, I don't see what is possible, because right now all my AI use cases are driven off of apps, and the apps run on cloud. That's what Oracle said. They need more cloud capacity. So if everything is happening on the cloud, why do I need to upgrade my device? And so to me, the real upgrade incentive comes from things that run on device from an AI standpoint. They definitely have the chips and the features, but I just didn't see a cool demo that will make me feel like, oh, I need to upgrade to the new phone because it can run this use case on device. If it's app-based, it's happening on the cloud, which is what Oracle is saying. We need a lot more capacity.
Well, and that's a problem not just for Apple, but for Dell and HP. And when my most used command is like, hey Siri, open ChatGPT, that's a problem, isn't it?
That's a problem, yes. Whereas if I can say, hey Siri, do this on my phone, that's when I will upgrade, instead of just opening ChatGPT.
I wonder why Siri's not listening right now. Maybe I have her muted. All right, Mandeep, great to get you on the program. As usual, Mandeep Singh runs our tech coverage for us at Bloomberg Intelligence, talking about the explosion in Oracle shares today and NVIDIA going up along with it. Coming up, we're going to get to, well, what used to be a commercial real estate story and is now increasingly an insurance story. Brookfield Asset Management preparing to kick off its investor day. We're live with Dani Berger at the company's headquarters next. This is Bloomberg Open Interest.
It's a bigger conversation about market structure and the changing backdrops about how investors think about investing from a 60-40 portfolio historically, and the tools they have to create better outcomes with less volatility. The reality is alternatives have worked for 40 years for institutions.
That was Apollo President Jim Zelter on what he'd like clients to consider sticking in the alternative space. Brookfield, another alternative asset manager with over $1 trillion under management, is set to kick off its investor day this afternoon. Dani Berger is at the company's headquarters early this morning in downtown New York. Dani, take it away.
Yeah, Matt, great to speak with you, and I'm so excited to bring you these interviews into the show. But there's a lot going on at Brookfield, and you could argue that this is an era of the next evolution of Brookfield, a Brookfield 2.0. In their last earnings, there was a letter and a conversation had about how this is increasingly an investment-led insurer. It is the insurance business that is really growing in importance for Brookfield. It is something they started 5 years ago, and Bruce Flatt, the CEO of Brookfield Corp, who I will be speaking to at noon today, said at that time that they see that this is a business in the long run growing between 100 and $150 billion. It's really important to stress the kinds of capital that are put behind this. It's now more individual investors investing in these types of assets because of the insurance model. It's something like an Apollo does, or even a Berkshire Hathaway. So it's a change for the giant, but again, it just means more capital to be put to work behind many of their strategies, and a lot of their growing strategies like AI infrastructure, Matt.
Dani, I think it's really fascinating, not only the turn to insurance, and we're going to talk a little bit later about that as well, but also the idea that even retail investors should be able to benefit, that's the idea at least, from these alternative investments in things like retirement accounts.
Yeah, I mean, that is a huge conversation happening in this industry, Matt, not just at Brookfield, but really wider. You'll recall that President Trump had that executive order opening up, not yet, but at least putting into the process of opening up 401ks to private assets. It's an argument that has been going on for some time, just considering the world is more private. There are less companies IPOing. The amount of public companies has shrunk by half. There are more companies going private, getting taken private. So if you want a slice of the American economy, can you truly just invest in public markets? And that's the argument that a lot of these private capital giants have made. The interesting thing that will happen, Matt, is what happens when more of the assets being invested by these private capital giants, that it's coming from retail investors and not from limited partners, not from institutions. What happens when that switch occurs? What does it mean about the type of investments? What does it mean about relationships with institutional investors? A lot of questions that need to be answered, and a lot of questions that will unfold as this evolution in the industry continues.
All right, so getting back to Brookfield specifically, as far as I can understand it, one of the most exciting things is kind of the transformation to investing in the insurance business and using those proceeds to get even richer. One of the other fascinating storylines with Brookfield for a while now has been its incredible investment in AI infrastructure. And after we heard from Oracle yesterday, we get even a more bullish picture of the AI build-out.
I was going to say just that, Matt. I mean, look at Oracle. It's still, you get this sense that we're in the early innings of this AI infrastructure build out. And Brookfield has made it very clear that they want to be part of this. They launched a new strategy specifically around AI infrastructure. There is so much demand there. And Brookfield has been doing this for some time. You'll recall in 2022, they partnered with Intel around an Arizona plant. It is a huge source of demand at this moment. But it needs things like power, like energy, something that Brookfield is also uniquely positioned to understand. It's a lot of demand resources coming from AI infrastructure, and increasingly more political too. I mentioned Intel, the government now getting a 10% stake in that company. So there are more stakeholders to this business now. But again, it's one of the things in this American economy, if you look at a labor market that is slowing, you get corporates that are more unsure. Where's the certainty right now? It is in AI, in the AI build out. So it's about positioning yourself there to make sure you can take advantage of it.
All right, fascinating stuff. Looking forward to your interviews and the Investor Day, Dani. And we hope you come back soon. Dani Berger, usually sitting right next to me here, obviously on set for Bloomberg Open Interest. Stay tuned for those exclusive interviews. Brookfield President Connor Teskey coming up next hour. Then later she's going to speak with the company's chair and CEO, Bruce Flatt. As we finish up the hour, let's take a look at markets and the fresh all-time highs that we're looking at. 65.41, 65.42 on the S&P 500, about 23,894 on the NASDAQ. Also coming up in the next hour, and I can see her offset right now, Nancy Tengler is going to join me from Laffer Tengler. We love to talk to her about her investments, plus JAB's Chief Investment Officer, Anant Bhalla, on that company's $3 billion acquisition of Prosperity Life Insurance. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller. Dani Berger is downtown for some exclusive interviews, as you just heard, with Brookfield's Bruce Flatt and Connor Teskey. She joins us with Connor later this hour, Bruce later on in the day. Coming up, stocks set for fresh records. A bullish outlook extremely from Oracle, fueling hopes that AI infrastructure spending is accelerating. And woof, shares of Chewy falling after the pet product retailer failed to live up to high expectations. Actually, CHWY, the ticker there. The CEO joins us later this hour, Sumit Singh. And Klarna is set to make its highly anticipated trading debut. We've been talking about it all year long, drawing stronger investor demand than even anticipated, raising $1.37 billion in an IPO on the New York Stock Exchange. Wall Street forecasters are rushing to boost outlooks for the S&P 500. Deutsche Bank, Barclays, Wells Fargo, all raising year-end targets on strong earnings and AI optimism. Oracle is the latest company delivering a bullish outlook and fueling AI hopes. Joining us for more is Nancy Tengler, Laffer Tengler, CEO and CIO, one of our favorite guests, and normally via satellite, so it's awesome to have you here on set, Nancy.
Thank you.
What do you think about this Oracle story? I mean, absolutely blown away by these earnings, and it really tells us that this industry is growing at a faster pace than we even thought yesterday.
Yeah. And so you had a lot of people coming out and saying nobody's making money on AI, it's not real, we're done. And what you heard yesterday from Oracle's, we're far from done, which is what we've been hearing from all the hyperscalers. So Oracle's one of the largest holdings in TGLR, which is our ETF. So is Broadcom. They are neck and neck. I think Oracle took over today. But if you think about Broadcom as the poor man's NVIDIA, I would characterize Oracle as the poor man's Microsoft. And they're taking share. They're partnering with the hyperscalers, but they're really showing that the pent-up demand, the backlog is enormous. And as you pointed out before we came on the air, I do think that there is a hierarchy. Who gets the chips? Interestingly, I do think Elon is on the list of getting the chips, right, but also clearly Larry Ellison, second richest man in the world, my neighbor in Lake Tahoe.
Well, congratulations on that.
Worlds apart. Never see him.
But also very close to President Trump, or in President Trump's orbit, right? When we saw that huge announcement at the White House on Stargate, Larry Ellison was there, and a lot of people thought, oh, that's odd that Larry Ellison, from the data center Oracle is
Who's
there.
Who's an advisor to Elon Musk. That's why I thought it was weird. I was like, where's Elon?
Well, Elon wasn't there, but we did see OpenAI there. So it's fascinating that they're getting these chips. Now, do you see, there was a story the other day about Broadcom finally offering some competition to NVIDIA. Do you see that panning out sooner or later?
I mean, at the margin, I don't think it's, sooner rather than later. I think it's a little bit later. But at the margin, I don't think that's going to impact NVIDIA's growth. I know people are concerned. There was a deceleration. But don't forget, when Azure came out, it was growing at 90% a year. And now it's only sob growing at 30% a year. So that deceleration will happen. We all know it. But if you look at NVIDIA, for example, on a price earnings to growth basis, it's trading at less than 1 times. So I think investors need to step back from the algos and the headlines and the hedgies and just say, who do I want to own for the long term? And as I've said, I've owned Broadcom for a long time. We've owned it since the CA Technologies transaction, which Wall Street hated, and that's always kind of a good opportunity to go, I'm going to take another look.
You mentioned NVIDIA. I mean, estimated PE is less than 40.
Yeah.
It's right around the same as Walmart.
Yeah,
and Costco is trading at 54 times next year's estimated earnings. What is going on with this incredible growing stock? It's $4.3 trillion, and yet still looks relatively cheap compared to expectations.
And compared to growth.
Yeah.
So I agree with you, but this is an opportunity. So we bought some at last July around 100. If it sells off further, we'll add to it.
Trading at 177 now.
Yeah, and that's not a bad trade for a year. So that's what we're always looking at. How using volatility as the friend of the long-term investor, which is what we are. The hedge funds drive the volatility in the short term, as do the algorithms. We're interested in taking advantage of that dislocation for the long term.
So obviously, we're looking at your 12 best ideas with, I see Microsoft there, I see Broadcom there, I see power there, which is interesting. The power side of this, is that fully priced in yet? Has everybody gotten into the power providers enough, or?
I don't think so. I really don't. I think the power shortages are being talked about a lot. If you think about what has held back Amazon and even Google to some extent, it isn't demand, it's the ability to supply. So I think we'll continue to see those companies participate in the rally. We own a couple of names. We own Palo Alto in there. We also own Goldman, and we own Chipotle, which
I was going to say CMG
does not feel like a best idea. So we've been looking for a replacement. We just haven't found the right name, but I think.
But do you want it to be in that space? Does it have to be consumer facing?
No, best ideas are best ideas. So the portfolio is pretty concentrated to consumer discretionary and to technology. We owned it before Brian Niccol left. We were happy as shareholders in Starbucks, but so far neither stock has done what you want them to do. So we're.
So you don't want to replace it with S-Bucks?
I don't think so.
Is the consumer a concern for you?
It is, but one of the things that nobody's talking about is in 2026, tax refunds are projected to go up $156 billion to $512 billion. So that's a lot of dough for the underlying consumer. And you and I are probably not going to get a tax refund, but the lower income cohort is, which is where I spent most of my life as a kid. Right. That makes a huge difference. So I think that's going to be positive for the consumer. Yes, we're seeing higher delinquencies, bigger credit balances, but not out of line with history.
I keep wondering about, the labor market is a concern right now, and I understand that slowdown, but the pool of labor has shrunk and is not going to grow.
Right.
So that means that the jobs that are there are going to have to compete, right, to get workers, and they're going to have to push wages up.
Yeah, I think that's the new paradigm shift. Again, no one's talking about. So look at the ISM manufacturing. New orders were up. What drug down the numbers to contractionary levels? Employment. Well, there's 450,000 manufacturing jobs that are not filled. If you can fill those with robots because you don't have the labor supply, things start to get really interesting. So I think we could see kind of muted ISM manufacturing numbers because of employment, but manufacturing going through a renaissance. So I think this is a new paradigm. I know you never want to say it's different this time. I don't know that it's different. It's just a productivity-driven growth environment analogous to the 90s, which we've been talking about for 4 years. I think I'm the only person on Wall Street that was alive and managing money in the 1990s.
Well, I wasn't managing money, but I was definitely, I was working at a record store downtown on Thompson between Bleecker and West 3rd. Nancy.
Oh my gosh, Tower Records?
Generation. Generation Records. Nancy, great to have you on set with us. Thank you so much for joining us. Nancy Tengler there, CEO and CIO at Laffer Tengler. Let's get a look at some of the single stocks moving at this hour. Novo Nordisk announced plans to slash 9,000 jobs globally and cut its profit forecast for the third time this year as it tries to compete with rival drug maker Eli Lilly in the obesity market that Novo pioneered. So it's a pretty shocking move there. They still have the biggest slice of the pie, of course. Shares of GameStop are rising after the video game retailer reported better than expected hardware and accessories sales for the second quarter. They still have brick and mortar stores that I guess the kids visit. And related stock, Chewy. Those shares are down almost 15% after the pet products retailer delivered disappointing results. They were largely in line, but the outlook failed to live up to high expectations from the market. And we're going to catch up with the company's CEO, Sumit Singh, later on this hour. We have breaking news on the Fed here. Stephen Miron's nomination for Fed governor has cleared a Senate panel vote. So Stephen Miron will be there at the meeting on September. Clears the Senate panel vote. So it looks like his nomination is going to be in time and his confirmation in time for the September 17th Fed meeting. We'll bring you details after the break. This is Bloomberg. Let's get to high interest now. Look at what's making headlines around the world. Stephen Myron, President Trump's pick for a temporary seat on the Federal Reserve's Board of Governors, just cleared a key vote by the Senate Banking Committee. Now, that means a full Senate confirmation vote on Myron's nomination is likely to be held on September 15th. And if he clears that, he should make it in time for the September 17th meeting, at which everyone else is also likely to vote for a cut. JP Morgan Chase, Fifth Third, and Barclays are among the banks bracing for potentially hundreds of millions of dollars in combined losses from loans tied to subprime auto lender Tricolor Holdings. Tricolor focuses on lending to borrowers across the Southeast who typically have poor or no credit scores at all. Amazon is reportedly working on two types of augmented reality glasses, one for consumers and one for delivery drivers. The move would put Amazon in direct competition with Meta, which is expected to unveil a new version of its AR glasses at its annual Connect conference next week. And turning back to private markets, investment firm JAB making a push into the insurance industry with its recent acquisition of Prosperity Life in a $3 billion transaction. Anant Bhalla, the chief investment officer at JAB and co-founder and CEO of 1823 Partners, joins us now on set. Anant, great to have you here.
Thanks, Matt.
I've been looking forward to talking to you because, well, the private space obviously is hugely important, even more so in the last few years. Dani is down at Brookfield Asset Management. You know those guys pretty well. And you're doing something, turning to insurance for a steady stream of revenues from which to invest. But you're doing it with a spin. What separates how you do it from other private asset managers?
Happy to share. So we are a firm that's been around JAB for 200 years, in its current form for 50 years. You may not know us, but you know our brands, Krispy Kreme, Lancaster, CoverGirl, Pete's Coffee,
yeah.
You know our brands. So we're an everyday firm. We're an everyday firm in consumer and now insurance. We've acquired Prosperity, closed on it on Friday from Elliott Management. Now we take care of 1 million American policyholders. 1 million policyholders in America. 1 in every 300 people. And we manage $30 billion of promises for them. So that's what we're doing about it. What's different about us? We're permanent capital. We're not private equity. We are permanent private capital.
So how do you ensure that that money is there for those policyholders in the event of a catastrophe? I mean, it seems to be a focus for you because you're focused on the actual people that you serve in the insurance business. But what do you do to make sure that those investments don't go awry?
You're spot on right. So we're policyholder first. So we start with an orientation of we're making a promise. You can be $1 trillion bank, $1 trillion asset manager. You cannot make a guarantee. For the privilege of making a guarantee, you have to have permanent capital backing. Where we invest, that's where our firm, 1823 Partners, comes in. It's a principal-first investor. We focus on never losing money. We invest in Main Street businesses, consumers. You have an interesting story out today about the consumer space there. That's where we do it. We never lose money. We don't go chasing returns. We are focused on delivering performance. We're aligned with the insurance policyholder because only if the policyholder wins does our asset manager win.
What do you think about the bigger story around private markets versus public? Yesterday, my co-anchor Dani Berger was talking about something Torsten Slok from Apollo said, which is, when we have, here's the quote, combined with the domination of passive investing, failure of active managers, and high correlation in public markets, which has been a real concern, high concentration in a few stocks, the reality is there is no alpha left in public markets. Do you think that's fair?
That's very fair. I could not agree more. Alpha requires curation of sourcing assets, understanding them, structuring them, and then surveillance. Those are the 3 S's of what we do well. There is no alpha in private markets. And why do returns matter? I'll give you a Burgess data looking at 10 years of different vintages, 2011 to 2020, 10 years of investing. The difference between the first quartile manager and the median, right, the 50th percentile manager in private credit is 290 basis points a year. You compound that over time, it adds up. It really adds up. The same difference in buyout equity is 780 basis points. Therefore, performance through the 3 S's. Source the assets, be a risk selector, not a market share lender, but a risk lender. Structure them appropriately, and then surveillance.
So what do you think about the increasing demand for private assets in mom and pop, retail investors' accounts, like retirement accounts, for example? You stress fiduciary duty, but not everybody in the industry does, right? So how do you deal with that kind of, inconsistent transparency?
I'm really glad you brought this up. We have a retirement crisis in America. The Trump accounts for babies is the right thing to do for every kid born in the next 5 years. They're going to get $1,000. That $1,000, if you earn 12% a year, will grow to $308,000. If you just add on the same kind of innovative thinking in the administration that's been done for children, to retirement, to ERISA, what's happened with the executive order is access. We've democratized access to alts because 90% of companies in America with more than 100 million of revenue are private. Private markets is where there's the opportunity. But we still haven't addressed ERISA. We still have not addressed. Those same children who get the Trump accounts, $1,000, if when they graduate high school, we say you have a guaranteed income for life, so we're a replacement for Social Security, that's big. Also in Social Security, you know the difference between waiting, if you're going to get like $2,000 a month in Social Security at age 67, if you get your timing wrong by 5 years, meaning you go at 65 and you don't wait till 70, that's a 43% haircut forever in your monthly paycheck.
Wow. Anant, we are out of time, but I hope you come back because it's fascinating to get your perspective here. And by the way, I would like 12% returns. That would be fine with me. I would settle for 12 a year for the rest of time. Anant Bhalla, their Chief Investment Officer at JAB, co-founder and CEO of 1823 Partners, joining us on Open Interest. Coming up, when Teslas lose power, crashes can turn into deadly races against time. We'll explore in today's Big Take next. This is Open Interest. In today's Big Take, Bloomberg has learned that some Tesla design features, such as door handles and mechanical releases, are confusing occupants and first responders at the worst possible time, when the car is on fire and the passengers are incapacitated. Here with more is Bloomberg's Global Autos editor, Craig Trudell. Craig, this is an issue for a lot of Teslas. I was recently stuck in a Corvette for a moment before I figured out that there is another latch to open the door. But obviously, if you're in a panic, if you haven't read the manual, and especially if you're incapacitated, that's a horrible time to be looking for it.
Yeah, that's right, Matt. And I think it's also the case that, all electric doors are not necessarily created equal, right? You can take steps to make it more intuitive or clearer for your customer to get out in the event that your doors have lost power, and not necessarily insert an entirely different latch or a sort of hidden cord for your customers to have to sort of dig through when, by the way, they might be trying to navigate around an airbag that's gone off in their face. So that's some of the detail that we dig into in this story. I think the other important point that we raise is that Tesla's kind of, on the cutting edge of moving to these electric doors. To your point, there were some models that preceded them, but in terms of the scale that this company was able to reach with its vehicles, and the fact that across its whole lineup, this is what you get. They really were sort of out front in making this move that the industry has increasingly followed, and some other brands are having similar issues that they've been having for years.
Right. Some are doing it better. One of my producers who has a Lucid pointed out that they have an electric latch, but if you pull it even harder, it operates the mechanical mechanism. And obviously, if you're in a panic, that's exactly what you're going to do. The story by Dana Hall was incredibly well written. I could not stop reading it to the last word. And one of the takeaways was, for me at least, NHTSA really hasn't been investigating these things, even though in other cases, like with a Dodge Journey, they had one complaint and opened an investigation. Do we know if they're going to move further on it now? And do we know if Tesla is going to take any steps to address the issue?
I think that's one of the key new bits of learning that we were able to get out of reporting this story and sort of digging into what's been happening is once we shared our work with the National Highway Traffic Safety Administration, they did come back to us and confirm that they are in contact with the manufacturer and also that they're contemplating whether a full investigation is warranted here. And to your point, this is a case where I would also add, in addition to that Dodge Journey example, there's a small number of questionnaires that Mustang Mach-E owners, shared with NHTSA that prompted NHTSA to reach out to Ford and led to a recall of the Mustang Mach-E. So it doesn't necessarily take a huge number of complaints or incidents for the regulator to say, you know what, you, Tesla, really need to do something here to address this.
I just want to point out while we have you, Craig, we're getting a red headline across the terminal. Larry Ellison surpasses Elon Musk as the world's richest person. You obviously have spent pretty much the entire time they've been public covering Elon Musk and Tesla. So it's interesting that, Oracle's earnings yesterday bring Larry Ellison ahead of him. Craig Trudell there covering autos for us out of London. He also runs the Hyperdrive newsletter, which I suggest everyone who cares about cars subscribe to. I want to get a check on the markets right now. We're looking at record highs on the S&P 500, 65.54. So that surpasses the intraday high and well past the closing high that we hit yesterday. The NASDAQ up 0.5% as well. Coming up, Dani Berger speaks with Brookfield Asset Management President Connor Teskey about that company's transition to an insurance-led model. This is Bloomberg Open Interest. Brookfield Asset Management is kicking off its investor day this afternoon. Let's head downtown, where Dani Berger is with the company's president and CEO of Renewable Power and Transition, Connor Teskey. Dani, take it away.
Matt, thank you so much. That's right. I am here with Connor, who is the Brookfield Asset Management president. Connor, thank you for having us. Wonderful to see you this morning.
Thank you for coming to our Investor Day.
So in your earnings, you released a letter co-signed by Bruce Flatt. In it, you said, we believe AI infrastructure is one of the defining themes of the decade. You've already plowed about $100 billion into just digital infrastructure. So what does it look like to capture AI infrastructure? What is the road ahead for Brookfield?
Well, AI is a major theme across all of Brookfield. It's driving our power business. It's driving our digital infrastructure business. We're using AI to drive efficiency in our operating and industrial companies. But without a doubt, the biggest opportunity is the role that private capital can play in funding the significant build out of AI infrastructure in this country and around the world. And we have built a platform that is dedicated to precisely this opportunity. It'll focus on building gigafactories on behalf of the hyperscalers and sovereign AI relationships around the world, and the supply chain and value chain that is required to fund that growth over the years and decades to come.
What is the timing like for this? Have you started to fundraise? Are you starting to look at deals already?
So we already have investors lined up for the strategy. We already have deals lined up, and we expect the momentum to continue, not only because of the opportunities that are in the market, but also the demand we're seeing from clients to get exposure to this theme.
There's a lot of demand, but I think there's a lot of people who have identified this too. I mean, you look at maybe non-traditional infra players, PIMCO and Blue Owl, for example. There was a report that they were looking to build out a Meta, or at least finance a Meta AI infrastructure. What does it mean for you, a very reliable face in infrastructure, to have more competition from maybe the non-traditional players?
So we like to think we play at a scale that very few can match. And our strategy and our platform will look to leverage our leadership in digital infrastructure, our relationship with the hyperscalers, our leading global power platform, to provide a market-leading product that can help pull these projects out of the ground at attractive risk and adjusted returns. And despite the amount of inbounds and new entrants to the space, there is still more capital needed than what has entered.
What levels of capital are we talking about?
This is a multi-trillion-dollar opportunity that is going to run for years and decades to come.
So you're incredibly bullish on this, clearly. But it feels like you're also very bullish on other parts of private capital, be it real estate, be it private equity, be it credit. In 2024, at the end of that year, a lot of people were very bullish too. So what's different this time that gives you the confidence?
Let's start with real estate, because that's probably the one where we're seeing the greatest change in the market today. And the reality is the fundamentals for real estate have been incredibly robust for the last 12 to 15 months. But what's changed in 2025 is, one, the capital markets have opened up, become incredibly deep and receptive for real estate credit, and two, the sentiment has changed. And we are seeing that show up in transaction volumes and in valuations. We've monetized 4 times as much real estate this year than at this point last year. We've actually invested 2 times as much this year than at this point last year. And we're really seeing that momentum continue. And we expect it will run throughout this economic cycle.
It's interesting because there are some pockets of investors being nervous. There's this wave of refinancing that's likely to come at the back half of this year in 2026. Even though you're very active, do you expect some pockets of distress as some of that refinancing happens?
There's a dynamic that's been true for a while, which is high quality real estate is significantly outperforming, and low quality real estate is struggling. That's showing up in who has access to credit. The other thing we're noticing is this real estate cycle is going to be in a more normalized interest rate environment, which means there will be less debt in the capital structure, and the market lends itself to those that can operate and create value in the assets. In the platforms we've been selling year to date, that is what has received premium valuations.
Just as you're thinking of the business as a whole, you mentioned rates. How much of this is just preparing Brookfield for what you expect, or if you do expect rates to come down significantly?
Rates are going to come down. Everyone sees that coming. But the reality is interest rates today are in a very normalized and constructive environment. If they're 25 or 50 basis points lower or 25 or 50 basis points higher, we don't think it changes the market backdrop, which is today very constructive for transaction activity. Year to date, we've monetized $85 billion worth of assets. That's one of our biggest levels of activity in recent years, and that's just because there is a constructive market backdrop. We don't think moves in rates change that.
Can we talk about the constructive market backdrop for credit? Because there's a lot of money chasing credit assets to the point where spreads have been so tight that even if you get moments of dislocation like April 2nd, they just snap back together. Is there a degree that there is just a structural force that maybe is causing some pricing that's not aligned with fundamentals, just because there's so much money going into the sector?
So private credit, which is driving these narratives, covers a pretty wide range of different types of credit. And there are no doubt some pockets where we do see a lot of capital flowing in and credit spreads very tight, maybe beyond what we're seeing in fundamentals. But in most pockets of private credit, for us in particular in real asset finance and in particular in asset-backed lending, we continue to see very attractive spreads because, quite frankly, the suppliers of that market are still outweighed by the demand. So there are pockets within credit, but private credit's got several years to run.
What happens when there's even more demand coming from retail money, from wealth money? What does it do?
Well, retail and wealth money and 401k and retiree money, this is a natural extension for most alternative businesses. It certainly is for ours. And really all it is offering the same products and strategies that we have offered to institutions in the past, but structuring those to meet the needs of a new investor base, which is the individual. And while it will bring more capital into the sector across the major themes that we invest in around the world, there is still significant room for investment. There's lots of capital to be deployed.
Connor, I just want to end it on private equity. Again, another one of the areas where Brookfield's incredibly bullish. I know you have some big predictions of how much your business is going to grow. But just in the past 24 hours, we've heard from both Apollo and KKR saying that the smaller firms, that a lot of them are going to start shrinking, that they're not going to survive. There hasn't been enough fundraising, enough capital deployment, and enough returns. For the industry, are we about to see a really big wave of consolidation?
Two things there. Yes, we do believe there will continue to be consolidation in the asset management industry. There's no question about that. And we've been active in participating in that trend for a number of years now. maybe taking your comments in the context of our private equity business, our private equity business is actually our oldest business. It's been around for more than 20 years. It is our highest performing platform. And what's interesting about that business is it focuses on industrials and essential services that produce cash across the cycle. And what that's done is it's really insulated us from some of the narratives around meager returns of capital to LPs. Because we have cash flow, we can either up-finance or even monetize even when markets are less than ideal. We've actually had a period of outsized returns distributions to our LPs. We think that drives our next leg of growth.
So you're going to maybe participate more in that consolidation is what I'm hearing if you're successful where others aren't.
We certainly expect to grow a lot in the near term.
Connor, thank you so much for your time this morning. I know you have a busy day ahead of it. We really appreciate it.
Thank you.
Matt, that is Connor Teskey, the president of Brookfield Asset Management. Very bullish, be it on private equity, real estate, and of course, AI infrastructure.
All right, excellent stuff, Dani. Thanks so much. And thank you to Connor for joining us as well. By the way, don't miss Dani's interview with Brookfield's chair and CEO, Connor's boss, Bruce Flatt. That's at noon Eastern time right here on Bloomberg Television. We see Klarna shares, by the way, indicated to open at $48 to $50 a piece. Remember, the IPO price was $40. Klarna says the IPO was about 25 times oversubscribed. So a lot of optimism for those shares, a lot of optimism for this market. The S&P 500 still up 0.5% at 65.44. That would be a high if we closed at that level. 65.12 was the previous closing high from yesterday at 4 p.m. before the Oracle announcement. Let's get a move at some of the single stocks moving at this hour. Oracle is really the big one. The shares surging on the company's aggressive outlook for its business. Larry Ellison has become the world's richest person for the first time, ending Elon Musk's reign in the top spot with this 40% gain. The company now worth just about $1 trillion. Trade Desk and other ad tech companies are falling after Netflix and Amazon announced an advertising partnership. And soon you'll be able to Uber a helicopter. We've been promising you this for a long time, but the ride-hailing app Joby announcing today that customers can book Blades helicopter and seaplane services within the app as early as 2026. This move is part of an expansion of Uber's partnership with Joby Aviation. So that'll be an interesting move, I guess, if you can afford it. It'll be expensive. I'm guessing very expensive. Coming up, Chewy shares not as expensive today as they were yesterday. After earnings fail to impress Wall Street, we'll speak with the CEO, Sumit Singh, next. This is Bloomberg Open Interest.
Willingness to spend on a pet, even in the younger generation, has never been stronger than it is now. You know, as maybe the less kids, more disposable income, that energy is going towards the pet market. Healthy pet. You know, when I grew up, it was outside. It's come inside. Now it's, you know, on the bed, and it's a big part of the families.
That was Elanco CEO Jeff Simmons speaking to us yesterday. Let's stay with pets. Chewy out with second quarter results today. The online pet products retailer matched expectations with a slight beat on revenue, but the stock is pulling back almost 15% in the early trade this morning because the outlook didn't live up to high investor expectations. Joining us now to discuss is Sumit Singh. He's the CEO of Chewy. Sumit, what do you think investors were hoping for? Why the big sell-off today?
Hey, Matt, nice to see you. Thanks for having me. So it certainly seems like an outsized correction because when you evaluate the fundamentals of the company, they are as solid as ever. You know, we exceeded the high end of the expectation range in terms of profitability, in terms of sales. We delivered on top of the range on profitability. We've raised the guidance. We are clearly taking share. Net ads are growing. Autoship subscription is up to 83% now. We're converting 80% of our profit into free cash flow. So, and all of this is fundamental structural growth. You know, pets are continuing to eat and they need more meds, and we are happy to supply.
So you think the stock shouldn't be down? Is that what you're saying? Or you can't understand why it is?
You know, our job is to run the company in the best of our ability. And what I'm saying is that when you compare the fundamentals, on which we're operating, right? Are we taking, share in the marketplace? Are we growing our subscription base? Are our customers growing? And are we converting and matching our long-range expectations on profitability? I mean, at this year, we're going to deliver at midpoint roughly 75 basis points expansion on EBITDA, roughly a 15% flow-through of revenue, and 80% of that profit is going to convert to free cash flow. So when you compare the fundamentals to what's happening in the pet industry, and when you segregate the share gainers from the shared losers, Chewy is clearly a share gainer, and we continue to extend our lead with pet parents.
I will say Jeffries said that the business clearly has momentum, but upside feels limited in this tough macro environment. So a lot of different commentators, analysts at RBC, at Baird, at William Blair, all saying that this feels conservative. It's not the kind of upside that they expected. Why do you think their expectations were too high?
It's exactly the kind of upside that we've communicated that we will deliver. So if you go back to our long-range, plan that we shared on Capital Markets Day, we essentially want to grow revenue at high single-digit to low double-digit percentage points. And the composition of that revenue is net ads file growing at about the high end of low single digits and share of wallet expanding mid-single digit. Well, that's exactly what Q2 is. And by the way, as we move into the back half, we've raised our sales guidance, which that tells you is we're projecting even stronger input metrics to come through. Now, when you look at profitability, we've guided to, on an average, we're going to expand profit roughly 100 basis points a year. Last year, we expanded more than that. It was about 150 basis points over the last 14 months or so. This year, we're expanding roughly 75 to 80 basis points. So on an average, per year, it's still about 100 basis points. And at midpoint, we're going to deliver roughly $550 million in free cash flow. So broadly speaking, again, I bring this back to fundamentals. And there is nothing differently that we would be doing in terms of serving our customers or our shareholders at this point.
I suppose it could just be very expensive, right? 100 times earnings is the stock price. Estimated PE is 70 times earnings. And, NVIDIA is estimated PE of 40 times earnings. So, but the bottom line, I think, that you would agree with, Sumit, is that people are willing to pay pretty much anything for their pets. How does the consumer look to you right now, especially after, household pet adoption swelled so much during the pandemic?
Yeah, so first I'd like to respond to your previous comment on kind of valuation of the company, right? I mean, look, the 83% of the company's revenue is subscription, right? So very few retailers that play in this space, right, have this quasi-subscription product that is a recurring revenue for long periods of time that converts at more than a 15% flow through, of which more than 80% converts to free cash flow. So the compounding, advantage of a subscription service like ours clearly provides differentiation. And I believe, that's what's playing through here. Now, in terms of consumers, we are the best positioned to both, provide them incredible proposition as it comes to the choices of products or services as you evaluate our health vertical, which is growing and continuing to add value to customers and shareholders. And on the back end of it, we are, really well insulated from a tariff point of view, given that 85% of our revenue comes from consumables and health and not hard goods and supplies, which are more, discretionary. So as we look to the back half of the year, we essentially are going to use these pressures that the rest of the industry is going to feel to essentially fuel and inject more growth and take more share, which is reflected in our top line guidance.
All right, Sumit, great to get that intel from you. Really appreciate you joining us. Sumit Singh there of Chewy, talking about the earnings yesterday and market reaction. Coming up, Klarna is set to IPO, and the market obviously reacting positive here. Indications that the shares will open about 25% higher than the price. More on the fintech's listing next. This is Open Interest. All right, we continue to wait for Klarna to begin trading. It is indicated to open at $48 to $50 a share. It priced at $40 initially, raising $1.37 billion and a reportedly 25 times oversubscribed IPO. Bloomberg senior stocks reporter Bailey Litschultz joins me now to talk about what really has been one of the most anticipated IPOs of the year.
One of the most anticipated IPOs, and one of those IPOs that, again, had its process put on pause after the Trump tariff announcement. We had been waiting for them to come back to market and really kickstart this process. So now they are finally going to list on the New York Stock Exchange today. As you mentioned, pricing that stock at $40, well above the top end of a range, which was 37. Talk about the overwhelming investor demand. When I talk to some bankers around the deals, they're just seeing a lot of demand for pretty much any IPO product, which shouldn't come as a surprise given we have seen some sharp moves in Figma, Circle, you name it.
So it's interesting that IPOs are now becoming so hot, such a popular move in a world where I thought companies wanted to stay private for longer.
Well, they do. And this is kind of the debate that we have on the desk. And this is a debate that banks and investors are dealing with. When you slide up towards the top 20, top 100 private companies, and you're talking about a SpaceX, an OpenAI, and Anduril, they can kind of raise money at whatever valuation they want. When you're doing funding rounds that are over $1 billion, those are huge checks to be cut in the private market. But these aren't those companies that are going public. So when you're looking at a Klarna going public today, later this week or pricing tonight, you have Figure, which is in the blockchain space. You have later this week Gemini, Via Technologies. Those are good assets, depending on who you talk to, but not these great marquee companies that, again, SpaceX is enormous.
So is this year the year that the IPO window opens up again? I mean, is this year the year that private asset managers get to make some exits?
I don't know. And when I talk to bankers, the big debate is there's a lot of appetite clearly for these deals in 2025. If the market stays open and stays hot, we'll continue to see those deals come to market. The big question is, what does 1Q26 look like? What does this look like for private equity companies that have debt? They have a lot of debt. These aren't companies that we're seeing going public that are your traditional, HVAC companies or your private equity roll-ups that are 4 or 5 times levered. These are, for the most part, growthy, younger companies. Granted, Klarna is 20 years old, so it's not quite a new, fresh face. But these are companies that are, for the most part, relatively quickly growing as opposed to an older industrials company, for example.
You mentioned a couple of the IPOs coming up, which, I mean, Gemini, right? If you care about crypto, and the Winklevi, that's pretty cool. But what's the next super hot one? What's the next Klarna?
Figure's pricing tonight, they're in blockchain home equity line of credit, which is a niche. I think the big one, though, that we're paying close attention to is this company Legence. They're Blackstone backed, they're a roll-up company, they have debt. That's going to be one that I think people are watching to see how private equity assets are viewed by the buy side. That'll price Thursday and trade Friday. But the big one people are watching for next week is Netscope. It's in the cyberspace. Cyber's very hot and at least appetizing. Zscaler's their best comp. So that one will be, I think, a big view into how are investors viewing the software space, the cybersecurity space, and really expectations around that. StepUp, a well-known name, but I don't think it's really on that level.
Dude, this has been an awesome year for you, right? Because IPOs are back, meme stocks are back, SPACs are back.
I get it right about Chamath. So, it's pretty much everything. I matter again, which is really cool because in 23 and 24, I didn't matter as much, but keeping me busy.
Well, we're glad to have you back from Tokyo. Bailey Litschultz there covers all of those things for us. Don't miss our interview with Klarna's CEO in the next hour on Bloomberg Tech with Edward Ludlow and Caroline Hyde. Let's get a market check as we go to break here. All-time high is where we look like we're going to close right now, 65.46 on the S&P. The 10-year yield getting back down closer to 4%. Coming up tomorrow, an exclusive interview with Brandon and Kyle Lutnick, Howard's kids. They'll discuss their leadership roles at Cantor Fitzgerald on location at Cantor's headquarters. This is Bloomberg Open Interest.